Here's the truth. I've been a CPA for over 40 years now, and I always have to help everyone with the same problem. You're not paying a lot of taxes because you legally have to. It's because you trust the wrong people who don't understand the tax law. Most CPAs and, frankly, enrolled agents aren't trained to build wealth. They're trained to record history. Let me show you what that mistake is costing you. Now, if you're already doing well, this might be the one thing holding you back. And once you see it, you can never unsee it. Why do most people, and most entrepreneurs especially, think they're covered on taxes with their CPA when all they're really doing is filing paperwork? See, they think, hey, I turned it over to my CPA. I trust they're taking care of it. Let me tell you what they're taking care of. They're taking care of getting the tax return filed. They're not taking care of reducing your taxes. They are just taking care of filing your tax return. Two very different things. Now, is filing your tax return important? Absolutely. Critical. You want to do it on time. Always, always, always file on time. Even if you have an extension, make sure you file on time. What people don't understand is that there's a difference between tax filing, tax compliance, and tax strategy. So why does that matter for somebody running a business? Because your number one job in your business is to increase your bottom line. That is your number one job. I like to say that the business of business is profit. And it's not before tax profit, it is after tax profit. In fact, I'll go a step beyond profit. It's cash flow. Cash flow is what makes a business run. Cash flow is the lifeblood of a business. And cash flow can go out to taxes even more easily than it can go out to any other expense, because taxes tend to be your single biggest expense. Outside of maybe your employees or your inventory, it's probably your single biggest expense. One of the biggest problems with owning gold is storing that gold. You pay month after month just to keep it locked away and your stack never grows. But with monetary metals, the model is flipped. Instead of you paying fees, they actually pay you in gold to store your gold with them. That means your ounces go up every month. Now, how does that work? They lease your gold to qualified vetted businesses like jewelers, refiners, mints that need it for inventory to operate. In return, you earn a yield, typically 2 to 4% a year, paid directly in gold. Now, how is that possible? Well, everybody knows that if you're a retailer, wholesaler, etc., you have to maintain a certain amount of inventory on hand at all times. And rather than buying that inventory, they're leasing the inventory from you. So they have the gold there in their inventory for 12 months. And after 12 months, you can get it back or you can renew your lease. That's how it works. So for many investors, this simple shift, turning the cost of storage into a yield on their storage, is the difference between watching wealth erode and watching it compound. Monetary Metals has already completed over 75 deals across 5 continents with thousands of ounces paid out to clients, and so far, 0 losses. So if you own gold, ask yourself, why let it drain you when it could be working for you? Go to monetary-metals.com/CPA today and see how your ounces could start growing again. That's monetary-metals.com/CPA and let them know that I sent you. Now, CPAs are trained to be accurate in their reporting. They need to be accurate. Very interesting to me is that the American Institute of CPAs recently changed its rules. And it used to suggest that it was a CPA's job to advocate or be on the side of their client. They changed the rules. Now they said the CPA may be an advocate, not shall be an advocate. I personally think this is a mistake. I think for me, as an entrepreneur, I want my advisors to be my advocate. I want them to be proactive on a strategy. I want them to actually hold me accountable. Now, a lot of entrepreneurs aren't up for that. They don't want to be held accountable. That's why I'm an entrepreneur, so I don't have to be held accountable. Well, guess what? Your cash flow holds you accountable. And you're accountable for it. It's your call. Do you want to spend the time? Do you want to spend the effort with a CPA who will actually create a plan of action for you and with you and work with you on a monthly basis, or out of sight, out of mind? If you want out of sight, out of mind, that's fine. Just remember, you're going to pay a lot more in taxes if you do that. Yes, your CPA may file that tax return on time. Good for them. Good for you, but you're going to continue to pay high taxes. When I get a prospective client come to me, it's not because they're concerned about their CPA reducing their taxes too much. Most people assume their CPA is playing offense. In reality, most CPAs aren't even in the game. See, I always say that the tax code is a series of incentives. So let me break that down. I'll start with an easy one. A lot of you heard of the tax benefits of paying your kids. What's the incentive? The incentive is to bring your kids into your business. Why would the government want you to bring your kids into the business? Well, I can think of a number of reasons. I worked in my parents' business. What was the benefit? Well, I got to understand the business in case I wanted to take it over someday. I learned how to work hard. I learned what goes on in a business. I actually learned a skill because I was in the accounting department. I learned accounting when I was in high school, which made it really easy. Let me tell you, when I got out of school and I had to do it on a full-time basis. So there's serious benefits to the government to have kids learning how to work, but they don't want them work for anybody. They want them working in their family business. So there's extra incentives if it's a family business. What's another one? What about the home office deduction? Isn't it great if you can actually incentivize somebody to use a part of their home productively in the world, right? If you live in your home, that's great, but it doesn't help anybody else other than you and your family. But if you use it for your base of business, which is very common right now, your business is helping other people. Well, what about if you go out and buy real estate and you rent it to other people? Now you're helping to solve the housing crisis. You think the government doesn't care about that? The government doesn't want you to solve the housing crisis? Of course they do. Well, one way to do that is to give tax incentives for owning rental real estate. Now, here's the thing. You get a little bit of tax incentive for owning a house that you live in, but you get major tax incentives in the nature of bonus depreciation for housing that you own that somebody else lives in. Here's the rule. The more generous you are, the more you do for other people, the less tax you pay. The more you do just for yourself, the more tax you pay. You make money and you spend it on yourself, you're going to pay tax on that. But if you make money and invest that in real estate, energy, agriculture, business, things that help other people, you're going to pay less tax. Now, if someone's overpaying and they don't even know it, what do you think's happening behind the scenes? What's the actual mechanism that causes that? Well, I think it's frankly ignorance on both their part and their CPA's part, and maybe not the CPA as much as them. Let's be fair. That means that they've decided, I'm not going to worry about it. I don't want to have to worry about taxes. I don't like taxes. They trigger me, right? So I'm not going to worry about them. I'm going to let the CPA worry about them. Doesn't trigger the CPA, right? But it doesn't trigger a lower tax bill either. And it may trigger an audit. So if you don't know you're overpaying, so just get a second opinion. It's not that hard. I've worked with people making millions of dollars and brought it down to zero. But I've also worked with somebody who's been paying $180,000 in taxes and brought it down to $67,000. Okay, now what actually changed? Typically what changes is how we answered two of the three most important questions. The first one is how you make your money. So instead of making it as a sole proprietor, we changed it to being made entity taxed as a corporation. And then the second question was even more important. When I've had clients where I reduced their bill by hundreds of thousands of dollars, always been what they do with their money. How are they going to use their money? Are they using it to help other people, to invest, or are they just spending it or saving it? So 100% of the time, the big difference is in the setup of their business and the use of the money. Those two things. Let's be clear. This is not about loopholes. It's about structure and who's helping you build it. Why is it so dangerous to have just one meeting a year, do you think, with your tax professional? And why is that the default for most entrepreneurs? I think it's the default just because they don't want to deal with it. It's out of sight, out of mind, right? I don't want to deal with IRS. They're the bad guys. I don't want to deal with it. But it's also because their tax preparer may be afraid of the IRS. And that's a serious mistake, to have a tax advisor who's afraid of the IRS or a tax preparer who's afraid of the IRS. Because what that means is the tax preparer presumes that the IRS auditor knows more than they do. And let me tell you, if an IRS auditor knows more than your tax preparer, you need a new tax preparer. You absolutely need a new tax preparer. So what you really need is a tax advisor, somebody who can set you up with an ongoing strategy. That's the difference. Do you want a tax preparer or a tax advisor? Even on a tax advisor, do you want an ordinary tax consultant or do you want a tax strategist? You want somebody to create a long-term holistic plan of action. Now, what about those people saying, hey, my CPA's been my CPA for a very long time. They're a friend. I really don't want to question their advice. I'm going, well, add a strategy without replacing the team. Well, the answer is you can add a strategy, but they've got to be willing to work with your strategist. Now, personally, I will not take on a client where I'm not doing both the strategy and the tax preparation. I don't have to do the accounting, but tax preparation is part of tax planning. So I would encourage you, if you're going to replace your tax preparer with a tax strategist, do it. If you're saying, hey, I'm going to use that same old tax preparer, you will fail. Do not do that, okay? But it's okay because they're okay with it. They understand. You've outgrown them. They're not willing to do that. Now, I would go back to them and say, hey, would you be willing to work with, say, Tom Wheelwright's team and learn how to be a tax strategist? Hey, I will take you on. I will take them on. I will help them. So give them a shot, but they need to be the ones. Your tax advisor needs to be a true tax strategist, needs to understand it. And you need that same person doing the strategy and the advisory as who prepares your tax return. Why do so many business owners still act as like employees when it comes to taxes? An employee thinks they're not in control. They're going to turn it over to somebody else. Somebody else is responsible. That's the employee mentality. That's the employee mindset. An entrepreneur's mindset is, hey, I'm in control. I'm willing to take this on. I'm willing to spend the time and the energy and the money to do better. That's an entrepreneur. Now, that's sometimes different than a regular business owner isn't willing to do that. A lot of business owners are really employees who own their job. That's what they are. So if you're a true entrepreneur and you really want to build something, then you've got to get out of that employee conditioning. You've got to take control, not just of your business, but of your personal life and your personal wealth as well. If you're still thinking this doesn't apply to me, that's the problem. Your results are tied to the strategy behind them. Now, if someone's thinking this sounds important, but I just don't want to deal with it, what do these people need to hear about the cost of doing nothing? Well, you do the same old thing and you get the same old result. So that means that you are losing millions of dollars in compounded wealth. Taxes are the single biggest drag on your wealth. You've got to get rid of that drag in order to accelerate your wealth. You can't be carrying a boulder behind your car or your boat and expect it to accelerate. It will not happen. And taxes are your boulder. So you've got to cut that loose. Now, you can cut it down to rocks. It'll still be a drag, but not as much a drag. But wouldn't it be great to cut it loose entirely? Now, if this is hitting a nerve, good. And it's not too late to fix it. You don't have to start over. You can start with where you are.